Barney. Barney, I'm trying to record a video. This is what I've got to put up with. It doesn't matter what Vanguard fund you are holding right now. You are hurting as your balance bleeds value every single day. There is simply nowhere to hide. And there's a good chance you're sat there wondering what on earth has happened to suddenly cause this sell-off, and realistically, what should you be doing about it? So in this video, I want to cover all this and also explain why I plan with no hesitation to continue to buy, even though I think there's around about a 30% chance that I might sell some of my position this year. And don't worry, I'm going to explain exactly why this might happen for me. Hopefully without coming off like a complete hypocrite, unlike some other YouTuber you might know. Finally, I'll check in on how much I've lost in the last month with a temperature check on where my Vanguard portfolio balance is currently at. So before we get into the details of what's actually caused the sell-off, I think it's important to understand what causes significant changes in the stock market. Well, the stock market is a bit like yourself. If you like it or not, you live your life with expectations. Expectations of your partner, the weather, and even your salary. As an example, if I was expecting pizza for dinner tonight and actually got dog food instead, I wouldn't be too happy about it. But if I was expecting wet food for dinner and that's what I got, I probably wouldn't be too fussed about it. It looks into the future with its own expectations of what's going to happen, and this is reflected with the stock market share prices that you might see. If its expectations for the future are quite frankly rubbish, and there's suddenly some surprising news that there's going to be a cut in corporation tax or there's record earnings from companies, then the stock market is going to go up as it reprices this new information. If today looks and feels a lot like the previous day, then it'll stay flat. And then we've recently had a great real life example of what happens when the market gets a nasty shock. The shock came from the fact that America's inflation rate is growing higher than anticipated. A little inflation is actually a good thing for the economy as it motivates people to spend their money as their money is slowly losing value over time. At least it's far better than deflation, where people are incentivized to save money as their money is gaining value over time, resulting in a slowing economy. But if inflation gets too high, then governments are forced to increase interest rates to cool this inflation rate down to get it back under control. Increasing interest rates are a fantastic tool for doing this, but there are lots of negative consequences in doing so, as increases mean that repayments on debts go up, meaning that any corporate debt that the companies you own might have suddenly become a lot more expensive. So when Jerome Powell, who's head of the Federal Reserve in the US, announces out of nowhere that they expect there to be 3 interest rate hikes in 2022 instead of 1, and then on top of that, they're planning on unwinding their economic stimulus sooner than previously thought, the market has a tantrum and becomes fearful of the future, or at least not as hopeful. You might sit there and think, big whoop, Nick, who really cares about the US? Well, the reason to care is that the US actually makes up a majority of the global economy, meaning it has a large drag on any global portfolios. If we take a snapshot of Vanguard's largest global ETFs, being Life Strategy 100, the Global All Cap, or VWRL, then you'll see that the US has a large weighting for these portfolios, either 40, 60 or 60% respectively for these funds. This means the remaining part of your portfolio has to significantly outperform to make up for this tantrum in the US. And this is ignoring the fact that fear tends to spread to other regions more easily due to globalization. As the saying goes, when the US sneezes, the rest of the world catches a cold. But it's not just businesses that suffer from increasing interest rates. You do personally too. That mortgage debt that you have, or the debt that you might have on your credit card, has just become more expensive, meaning you'll be able to buy less with your money, which further suppresses corporate earnings, and that's even before your energy bill goes through the roof. So over the last month, the stock market has been adjusting to this new future that it's looking at. How it's going to perform over the remainder of the year depends on how our expectations change throughout the rest of 2022. But I appreciate that for a lot of viewers, this might be the first sell-off you've been through. You might be sat there looking around going, this is really unfair. The stock market has done nothing but go up for the last 8 years, and then as soon as I start investing, the market goes down. Well, if you do feel like this, then you're probably looking at the past 8 years through rose-tinted glasses. Personally, I've been investing since the start of 2018, which for long-term investing isn't that long, and I've had 8 sell-offs of over 5%, 2 sell-offs of over 15%, and then one sell-off of over 20% just in that period. And the last 4 years is actually fairly representative of the historical data that we have. Since 1929, there's been an average of 1.7 sell-offs per year of 5% or more. So if you're wanting to invest, you really need to be expecting at least 2 sell-offs of 5% or more per year. And that's just 5% sell-offs. They can be much bigger. Based on historical data, any 5% sell-off actually has a 46% chance of turning into a 10% sell-off, a 21% chance of becoming a 20% sell-off, and then a 14% chance of being a huge 30% drop. But even with the data of all these wild swings downwards, just look at what the S&P 500 has done since 1982. The long-term trend has continually been heading up, no matter the size of the downturn. It really doesn't matter what strategy you look to use when investing. The overriding evidence shows that the biggest factor on how successful you are at investing is how long you've been investing for. So the shorter the time you've been investing into the market, the more likely you're going to be in the red. It's part of the course. If I look back over my investments over the last 4 years, you can clearly see that I've swung in and out of profit over this time. But as time's gone on, these losses have become fewer and smaller as I've continued to invest. And I've actually not been in a loss since mid-2020. But I would like to stress that this doesn't mean I won't be in the red again. My average buy price right now is £70.94, meaning that if the market dropped a further 20%, which based on historical data has a 1 in 10 chance of happening, I would be back into a loss. If you're in a position where you want to sell right now due to the recent downturn, then the mistake hasn't been made now. The mistake was actually made at the start of your investing journey. You've either invested more money than you can afford to lose, your time horizons are far too short, or you simply don't have the right temperament for investing, or it could be a combination of all three. Investing into equities is a long-term game. So what the market does over the next day, month, year, or even decade really doesn't matter one bit. It could literally drop for 90% for all I care, as I'm in no position where I actually want to crystallise any losses anytime soon. The Irrelevant Investor have a fantastic graph that I love looking at, which maps out all the fear surrounding the stock market over a time period. Just in the last 10 years, if you think about it, we've had COVID, the US-China trade war, Brexit, Ebola, the US government shutdown, the downgrading of US debt, the flash crash, and even the European sovereign debt crisis, and many, many more. A lot of very good reasons to be fearful, but the stock market has continued to travel in only one direction, and that is up. To be an investor, you only need to believe in one simple concept, and that is capitalism. It's a belief that businesses and entrepreneurs will continually build value for wider society in the face of all the challenges in the future that might come our way, whether it's climate change, political unrest, population explosion, or population collapse. You've got to believe there'll be bigger and better products and services in the future to increase the size of our economy. For better or worse, I believe in the sustainability of capitalism, which is why I'm going to continue to invest each and every single month. So why then might I sell some of my portfolio in the next year? Well, let's firstly check on how much my account has actually lost in value over the last month. If this is your first Vanguard Portfolio update, then you only need to know 3 things. First, I invest into VWRL, which is known as the FTSE ALL-WORLD UCITS ETF. I've been investing since the start of 2018, so this year is my 5th year. And finally, my strategy is lump sum investing. So any money I have left over, I throw into VWRL no matter the price. In terms of last month, I held around 790 shares of VWRL priced at £92, exiting 2022 at near all-time highs. This gave me a total portfolio value of £72,600, which is a great number considering that I only started last year at £49,000 and started from zero in 2019. But it goes without saying that January hasn't been the best month for the stock market. A mixture of the Fed changing their guidance in the US and some companies narrowly missing their quarterly expectations has really shaken up the market, where the sell-off had reached a bottom of 8% but has recovered slightly to only a 6% sell-off at the moment. If you're any good at maths, then you'll quickly figured out that I'll probably have put my portfolio down to £67,000, meaning at one point I had a £5,000 loss versus last month. But during that time, I've actually received my Q4 dividends of £267, which I've of course reinvested straight away. And then on top of that, I've kept up with my direct debit of £940 that went in just over a week ago. Adding this all in with a slight recovery we've had over the last week, my portfolio is now back to around £69,816 with gains of just short of £15,000. So if my investments are going so well and I have a long-term mindset, then why on earth might I sell this year? Well, I'm in the same position as anyone else, I imagine. I'd only be forced to sell if I had a large unexpected bill, or I believe I could get a better return elsewhere. But I do believe that investing in equities is the way to go for investing. In my mind, stocks offer a far better risk-reward ratio than crypto, bonds, or gold. So the only way I might find a better return is find other ways of investing into different types of equities. So what form of equities might I be looking at? Well, some of you might have noticed I've been noticeably quiet over the last 2 weeks on YouTube, and this has primarily been down to the fact that I've had to be working hard on my side business, the K9 Menu, in my spare time. The reason why I've been so quiet is that the fact that my business has done a 3x in just the last 4 weeks, so it's been a little bit manic. There's a famous saying in one of my favourite movies called Margin Call, which goes as the following.
3 ways to make a living in this business. Be first, be smarter, or cheat.
So with my case of the K9 Menu, I believe we happen to be the first in what we're doing, or at least in the way we're approaching what we're doing at least. And while knowing that, I'm desperately trying to be smarter, as I know competition will come eventually. It's a question of when, not if. And one of the biggest killers of businesses within their first 3 years is cash flow problems. It's funny that you can have a profitable business with good levels of demand and still fail. Lacking in cash flow can be based on lots of different factors, but primarily it's down to building a solid inventory so you can keep up with demand while investing into operational efficiencies, meaning that you can create your finished product quicker and easier. I've personally got aggressive growth plans for the K9 Menu over 2022, where I actually want to take the company through a further 5x. And in doing this, I'm probably going to need some support with cash flow. If I was to take out, say, 20 or even £50,000 on my ISA, then the real question I need to ask myself is, would the risk I'd be taking be worth the additional outperformance I might get in the stock market? I can't answer that question at the market, but I might need to in the future. But if you want to follow the journey that I have with this company, then feel free to check us out on Instagram at the K9 Menu. But I am hoping to do a video on the K9 Menu at some point in the next few months. But maybe you're in the mood for something more controversial. If so, why not check out my video on what I believe is the real problem with Martin Lewis. That's all for this video. See you in the next one.